Did you know that millions of UK pensioners are about to receive a £575 boost, and the exact date has finally been confirmed? Yes, you heard that right. After months of speculation, the government has officially revealed when the new state pension increase will kick in. But here's the twist: not everyone will get the full amount, and missing one small detail could mean you lose out on hundreds of pounds. So, before you scroll away, stay with me for the next few minutes as I break down who qualifies, how much you'll actually get, and the exact date your payments will rise, all explained clearly and simply. Welcome to UK Insight, now your trusted guide for pensions, benefits, and senior living in the UK. Stay informed, stay supported, and enjoy your golden years with confidence. Subscribe now and join the community. Let's start with the basics. The state pension in the UK has two main forms: the new state pension and the basic state pension. For those who reach pension age under older rules, the new state pension is paid to men born on or after 6 April 1951, and women born on or after 6 April 1953. The basic state pension applies to earlier pensioners. Because of historical differences in the system, the amounts vary, but both are subject to uprating via the triple lock, though the new pension benefits more consistently. Now the key, the triple lock. Introduced in 2010, this mechanism means each April, the state pension rises by the higher of the increase in average earnings, the rate of inflation, CPI, or a guaranteed 2.5%. Because wages have grown strongly in recent years, the earnings growth figure has often been the highest, which means a stronger boost for pensioners. This year, figures indicate that the earnings growth figure wins out, meaning the rise is meaningful. According to recent analyses, this will translate into around a £575 annual uplift for many pensioners. Let's break that number down. For those on the full new state pension, this extra £575 over a year works out to about £48 a month, or roughly £11 a week, depending on rounding. For someone on the basic state pension, the uplift may be slightly less or more depending on additional pension elements, but the figure gives a useful ballpark. So when will this increase take effect? The date to mark is April 2026. That is when the new rate applies. Pensioners do not have to apply for this uprating, it happens automatically. The payments after April will reflect the new higher rate. However, there are some caveats. The £575 figure, or similar, applies only to those who receive the full new state pension and who satisfy the eligibility rules. Some pensioners receive what's called the additional state pension, also known as SERPS, or the state second pension, or retired under older schemes. These pensions may not benefit fully from the triple lock and may instead be uprated by inflation alone. This means some will see a smaller increase. It's also worth noting that although the boost is automatic, the actual amount you receive depends on your personal pension rate and national insurance record. The full new state pension requires 35 qualifying years of national insurance contributions or credits. If you have fewer, your pension will be correspondingly lower, and so the uplift will be proportionately smaller. What does this mean in practical terms? Let's go through a few scenarios. Scenario 1. You're on the full new state pension. The weekly payment before the rise might have been around £230, 25p. With a roughly 4.8% increase, the likely figure for April 2026, you could see payments rise to about £241, 30p per week. Over the year, that adds up to over £12,500 annual pension for the full new state pension. That means your extra income thanks to the uprating is around £575, or slightly more depending on rounding. Scenario 2. You're on the basic state pension. The amount is lower overall, so the uplift might also be lower in absolute terms. But the percentage increase still applies. The important thing is that the rise helps maintain the purchasing power of your pension, particularly in times of higher inflation and cost pressures. Another practical issue to highlight: tax. Because the personal allowance, the amount you can earn before income tax applies, is frozen. If your pension income rises, you may end up paying more tax or paying tax for the first time. For some pensioners, that can offset part of the benefit of the rise. Analysts warn that pensioners with additional income, private pension, savings interest, etc., should check whether the uprated pension will nudge them over tax thresholds. So what should pensioners do now to make sure they're ready and to maximize the benefit of the uplift? First, check your pension forecast. You can access your state pension forecast online via the government's Check Your State Pension service. This tells you how much you're likely to receive, when you'll receive it, and how many qualifying years you have. If your record is missing years, you may have the option to pay voluntary contributions. Ensuring your record is accurate is key. Second, check your bank account details. Although the change is automatic, you need to have your payment channel set up correctly so that any increase flows smoothly into your account without delay. Third, consider your overall income and tax position. If you have other income, private pension, savings interest, rental income, etc., you may want to review whether the uprated state pension will affect your tax position. For some, the extra income may push them into the income tax zone. Fourth, review your budget and spending plans. This extra £575 or thereabouts may not seem enormous at first glance, spread over months. It's modest, but when you factor in that every extra pound helps, when costs are high, it could make a real difference. Perhaps allocate the increase to debt reduction or build a small buffer for unexpected costs, energy bills, repairs, etc. Fifth, beware of scams. Whenever there is news of pension increases, scammers exploit the interest by claiming there are special forms to fill out or that you must claim your boost. In reality, this change is automatic and you should never be asked to pay money or give bank details for the increase. If in doubt, consult the official government site or trusted organizations. Let's pause and reflect on why this rise matters. Retirees often live on fixed incomes. Many costs, energy bills, food, housing, care costs continue to rise or remain volatile. A rise of around £575 may not solve all financial challenges, but it does preserve value, meaning your pension keeps pace with rising earnings and inflation, rather than falling behind. The triple lock mechanism is precisely designed for that, to protect older people from value erosion. From a broader viewpoint, this increase is a political and economic statement. It reflects a commitment by government, currently, to honor the triple lock and to ensure that pensioners share in the country's earnings growth. At the same time, it comes in a context of fiscal constraint. The cost of uprating state pensions is significant when multiplied by millions of pensioners, and some economists question how sustainable it is over the long term. But for now, the message is clear: pensioners will see the uplift. What about the exact date of the payment? While the increase applies from April 2026, pension payments are made every 4 weeks or monthly in some cases. Depending on your setup, you don't need to claim anything. You just need to ensure you're eligible, your account is correct, and you continue to meet the residency and contribution conditions. If you've started receiving pension, the new rate should apply automatically from your next payment cycle after the uprating. Now let's highlight some of the things pensioners should check or watch. Confirm your national insurance record. Check how many qualifying years you have. Missing years could mean a lower pension and thus a lower uplift in absolute terms. If you're deferring your pension, check how the uprating affects you. Deferring may change how the rise applies. If you live abroad, Check whether your state pension rate is frozen or subject to a different rule. Some countries have frozen pension agreements and may not benefit from full operating. If you have additional private or workplace pensions, review how the increase in state pension interacts with your overall income tax position. Look at other entitlements, such as pension credit, free TV license for over 75 SE, winter fuel payments, and other support services that may also be affected by changes in income. Update your budget. Even a modest uplift can help offset cost rises. If you haven't reviewed your monthly outgoings recently, this is a good time. Thanks for watching UK Insight Now. Don't forget to like, subscribe and share with other seniors who need this info. See you in the next video. Stay well, stay informed.